final presenter in the Big Buckets section is Marc-Andre Lewis from CIGAM, Toronto-based and French-Canadian by background. Marc-Andre holds a PhD in theoretical physics from the Sorbonne and has been analysing portfolio risk on behalf of sovereign, institutional and wealth advisors in both Canada and the Middle East for the last 20 years. Marc-Andre, I'll apologise up front for my Australianisation of your name. Please introduce yourself when you come on stage. Marc-Andre.
Thank you very much, Ben. So it's Marc-Andre Lewis, but it's the last name kind of like that shows I'm a true Canadian. My first name is French, and then the last name is English. So when you're the third on a panel, you end up saying a lot like what Kevin and Alex said, right? So I'm going to do it with a different accent. I wanted to focus, instead of fixed income and equities like we saw, how do we translate that into risk-taking in terms of like, obviously we manage portfolios, we need to take these views, and you'll see, broadly speaking, I think my views are broadly aligned. Then the question is, okay, how do you build portfolios? How do you express views? How do you manage throughout all of that, right? So the first thing is I think we live in a complex world, right? And I think that more and more confusion is used as a weapon, right? In a way to get things done or get things through. And it's complicating a lot the role we have as investors. I'm a physicist, I'm a scientist, I approach things, investing, with, I would say that mindset, right? So the question is, okay, you need a framework. In order to be able, we're not paid to take risks. We're paid to take calculated risk to establish conviction, and we should scale the views we express in portfolios according to that conviction. And throughout the last 25 years, what I've done, and I think what a lot of successful investors have done, is develop a framework, try to understand how things work, build indicators for the different moving parts, and from there establish conviction levels and establish positions. When it comes to monetary policy, that's one example. You get the drill. That's a simplified, obviously, monetary cycle, but broadly speaking, you can develop views on the short end of the curve and eventually on the longer end by going through this cycle. Rates, inflation, and growth have patterns, and if you are able to see how they evolve, you can establish views, and you've been able to. The problem is this has been and is being broken. As Kevin said, we now have officially kind of broken Fed independence, and that kind of messes up a lot with the framework we've been using. And I think that this is true not only on this front, but also on a lot of other fronts, right? So what is happening now is kind of like a lot of misunderstanding, a lot of like prudence, because the way we thought things were working is being jeopardized. And I think it's important first to realize that we need a neutral point. It is okay not to have strong convictions. There are environments where strong conviction is not warranted. I think it's one of them, and I'm going to try to explain it in a bit in the next few slides, right? So I will look at strategic outlook, tactical outlook, and then try to merge both of them. And on the strategic outlook, a lot of things have already been said, right? When you look at equities, rest of the world looks still better than US. Obviously, US is, I would say, a barbell, if you want, where you have tech leading the rest. But overall, I think we're more comfortable owning rest of the world equities. Credit spreads are tight. The front end is likely going to be helped by short rates being cut. But still, you see that EM debt looks attractive. Alec made the point. I agree with that. The US dollar still is expensive, as Kevin said. It's still very expensive relative to CAD. The Aussie dollar, as he presented, is pretty similar. That being said, a lot of the ground has been covered, and that was also in his graph, right? A lot of the ground has been covered relative to Euro and GBP, right? So depending on which markets you operate in, the level of expensiveness of the US dollar is probably not as big as it was, but it's still there. What we know also is energy demand is there. The whole AI complex and computation is driven by and raising a lot energy demand. And other things we're doing, electrification of vehicles and all that. So the energy output is likely smaller than the future demand. That's also something that is helpful to build strategic views. And finally, on AI, I think in general it's true of every technology. It was true from the internet at its beginning. We tend always to overestimate the impact of a new technology on the short run, but to underestimate the impact it has on the longer run. So there's likely going to be some deception or disappointment when it comes to the impact of AI over the short run. There's a lot of fun stuff we can do with it, but because of that, we should not underestimate how much it's going to transform the world economy and our own individual life over the next 10, 15, 20 years. When it comes to tactical outlook, well, if you've seen some of these presentations, you've already seen 3. Nobody shows up on stage saying the US dollar is cheap. And from a tactical perspective, that worries me, right? I think it's a crowded trade from a tactical perspective. Doesn't mean that strategically, I don't think that we still have ground to cover, but on a short-term basis, it starts to be kind of the obvious trade. And when a trade is too obvious, typically it's dangerous. The US stock market is not the US economy. The US economy is slowing down. Employment starts to disappoint. But the US economy composition, more and more, is different from the economy itself. And I agree. Tech still has a lot of momentum, is likely going to continue to have, even if the US economy, which means that the US economy can slow down while still having, at least on aggregate, a US equity market that behaves well. There's a gap between what is said and what is done. It remains. We see it on the tariffs. So again, talking is what is used to influence opinion, but look at what is ultimately done, and there's a gap, and the gap is significant. We prefer to take positions on what is done and not too much on what is said. And the last point is probably the most important, is there is, and we're going to start to see it this week, there is potential for massive fiscal and monetary expansion and support from authorities, and we're going to see it. So it's difficult, although it's very uncomfortable, it feels uncomfortable from a political perspective, it's difficult to be very negative when it comes to market, we think, on the short run, right? I think a lot of things that are being done right now are going to be overdone and are going to create danger down the road, but for the time being, I think there's still a lot of reasons to be relatively optimistic about markets. So when we bring those two views together, what can we say? Well, first, when you start to see politics interfering with markets, it creates a lot of binary risks. Is the US government or the US president going to do this or that? Is a binary risk. And sometimes the outcome of these decisions can be extremely different, but they're typically not the things you want to take views on or you want to put risk on. Because a binary risk is, I mean, again, a coin toss or extremely dependent, in this case, on things which you don't have a framework, or unless you really are into the president's head and you know what they're going to do, it's not extremely interesting to take views. The monetary policy is becoming too entangled with politics. Again, jeopardizing our whole framework. So it's very difficult to establish strong conviction. Low active risk is warranted, right? It's not bad. I think it's appropriate for the current environment. The last point is important, right? Obviously, in an environment that feels uncomfortable, but markets are going up, a lot of people are turning to portfolio insurance. What can I do that will protect me in case something unexpected happens, right? And here's a graph on the right, which I think is very insightful, and it shows on the dark blue line, if you bought every single day since 2018, a 5% out of money put on the S&P 500, a 3-month option. And in gray, 3 months later, so you can compare the blue point with the gray point at the same place, so we moved, if you want, the terminal value of that option. Buying puts on the S&P 500 looks extremely smart. It looks like a good trade, and from time to time, it's a spectacular trade, but it's extremely rare, right? So it looks like a smart thing to protect your portfolio. It's very difficult to do. I think there are points in time, but typically you need to identify a trigger. You need to think about what can happen. Is something more likely to happen? Is the market complacent enough and doesn't capture that before you take a position? And I have 50 seconds left, and I have lots of words, but the current market rally is one of the least loved that I've seen in a very long time. It's good. right? Again, being positive on market is not a common view right now. I think part of it is because we tend, even as investors, to jump from the conclusion that we don't like the way things are done, or we don't like the political environment, and therefore we need to be defensive. And I don't think that's necessarily the case, right? So again, a lot of stimulus is in place. We don't understand the way decisions are made, therefore we don't have to take risks. All of that goes back to the last point, which I think is the most important and the most viewed point, is that you need a clear definition of your neutral point. What is your strategic asset allocation? Are you comfortable with it? As your strategic asset allocation drifted over the last few years because of US outperformance? Is your portfolio too concentrated? So while it's not interesting to position yourself for the next 3 to 5 months probably because risks are too high, it's a very good point to ask yourself, do I have the portfolio that is needed for the next 5, 10, 15 years? So I'll pause here and I'll be happy to be part of the panel. Thank you.